Welcome back to the Party Daily Podcast, the show where we keep you up to date on the latest trends in multifamily real estate. On today's episode, we have 3 great articles for you, and this is the second episode of this edition. So basically, in these episodes, we'll look at 3 articles in the multifamily space. These are 3 headlines that's going on in the industry today. I read the articles, and all of these articles can be found on our newsletter. If you're not a member of the newsletter, go ahead and join now at apartify.co/news. All of these 3 articles that I'm reading is on our daily newsletter. So if you want to see any of these articles, you can go to apartify.co/news. So the thesis of the show is to come on, look for 3 headlines in the multifamily space, read them, and then I break them down here on the show. So we have 3 great headlines today. Let's go ahead and get right into it. So this is just in. This is literally what we were just talking about yesterday. So you remember when I was saying yesterday, all of these office space, if you haven't watched the episode, go back and watch episode 1. But yesterday I said the headline and the article that we read yesterday was saying that office to multifamily conversions are going to be the next big thing. And so I was saying yesterday that maybe, this isn't going to be the next big thing. Maybe they're going to try it out and then run into some hurdles and realize that this is not the right approach to take and things like that. So let's look at this article. This article is just in today. The article reads, Atlanta office conversion stumbles. 41 Marietta Street faces foreclosure. So remember, I was just saying this office space to multifamily may not be as good as, everybody's painting it out to be. All right. So basically, our article reads, today we focus on a cautionary tale unfolding with the office to apartment conversion space, or the office to conversion project, 41 Marietta Street. So 41 Marietta Street, from dream to delinquency. An ambitious plan to transform a 13-story office building into a modern apartment complex has hit a roadblock. The owner, linked to Plano, Texas-based Wolf Investments, is facing foreclosure after defaulting on a $20 million loan secured in July 2021. The property is now slated for auction on May 7th at the Fulton County Courthouse. So, a lesson for conversion enthusiasts. This news serves as a reminder of the potential challenges associated with the adaptive reuse projects. Converting office buildings into apartments require meticulous planning, robust feasibility studies, and a significant upfront investment. So what went wrong? While the specific reasons for the default haven't been made public, here are some potential factors that might have derailed the project. Number 1, soaring construction costs. Number 2, shifting market dynamics. And number 3, unforeseen delays. So now the question remains, is Atlanta still viable for conversions? While this specific project faces foreclosure, the Atlanta market remains fundamentally strong. Here's what to consider before diving into apartment conversions. So all of that is in the newsletter article. If you want to see this article, go to apartify.co/news, get on the newsletter, and you'll start seeing the articles pop up in your email. So here's what I have on this. I literally just said this yesterday, that office to multifamily sounds really good, but there are some major hiccups that developers are going to run into. And the number one thing that I was looking at was cost. Cost is going to be a major thing that could derail these investments. And when you're doing large multifamily deals, cost is important. You got to keep those costs to where you modeled at or where you underwrote at. Otherwise, it just blows up the entire deal. And so, said it yesterday, office to conversions may be more expensive, and we may start to see more deals like this go into foreclosure because they realize that this strategy sounds better than it actually is. And then maybe we may not see more. Maybe somebody will, crack the code and realize how to get the cost down and all of that. but I think we'll see more before we see, success. We'll see more foreclosures in the future before we see success. And while I want to make sure I put this in here, I don't know the owners of Wolf Investments, and I'm pretty sure they're a phenomenal company. This deal was just a deal that was not the best deal to do. And so sometimes when you're in a multifamily space or when you're doing a large volume of transactions, you got to let a couple deals fall by the wayside so that way you can keep on going and growing your firm. So this entire article that I'm reading is not to bash Wolf Investments. They seem like a pretty legit firm. I don't know anything about them. And you're going to have some casualties along the way if you stay in the game long enough. So that's what I have on that. Let's move over to article number 2. Article number 2 reads, Luxury Rent Retreat, Downturn in High-End Apartment Market. This newsletter just seems like we're just throwing doom and gloom into the marketplace. The first one was about office foreclosure. This one is about downturn in the high-end market. I promise you, that is not the intent to only sell doom. We're going to make sure we get some good articles in here where we sell the upside as well. But this is just what we have for today. So, according to a recent report from Globe Street revealing a significant shift in the luxury apartment market, here's what you need to know about the weakest rent growth in recent memory for upscale units. So, luxury loses its luster for now. The article paints a picture of a softening luxury multifamily market. Asking rents for an upscale 4 to 5 star related apartments have actually dipped year over year, making a significant departure from historical rates. A glut at the top. The culprit behind the slowdown is oversupply. A surge in construction of luxury units in recent years has outpaced demand, leading to a surplus of high-end apartments in some markets. Sunbelts feel the squeeze. The Sunbelt region, known for its booming housing market, is experiencing some of the steepest rent declines for luxury apartments. This is likely due to an overcorrection in some areas where luxury developments went into overdrive. So is there a potential for silver lining for renters or savvy investors? So for renters, this news signifies a rare opportunity to secure high-quality luxury apartments, potentially at a discount. And for investors, a more balanced market might present opportunities to acquire well-located luxury properties at attractive entry points. However, make sure you do your due diligence because that is going to be key. So, that article is just that article. I think it plays into what we were talking about yesterday as well. This is not on purpose. I would say that. So we talked about construction halting on our last episode, and then we're looking at oversupply of luxury apartments. So it's actually good that construction slowed down, but that leaves us with oversupply. And when we have oversupply, what happens? The demand comes down because you have more supply. And so when the demand comes down, that means the price comes down. And then it kind of balances things out. And so this is actually a good thing. So it's bad for the developers who built the apartments and the multifamily owners who own the apartments. And it could be bad for them if they have to get out of the deal quickly. But if they're in it for the long term, this is a good thing for them because they can fill their units up. Maybe they don't hit the numbers that they need to hit right now, but if they fill those units up, they'll be better off in the future 5 to 10 years from now because they can hold it long term. Now, if they need to sell, this is bad because they have to sell at a discount because they're not leasing the units up and they're not leasing the units up at the market rents that they were projecting. And being that they're not listing the units at the market rates that they're projecting, this causes the NOI to decrease. And when the NOI decreases or the projected NOI decreases, guess what? The value decreases as well. And when the value decreases, guess what? The offers decrease. And when the offers decrease, you have to take a lower price point for a deal that you were assuming that you were going to get a higher price point for. So it creates a dramatic effect for the sellers. Now, when the buyers buy it, this creates a good deal for them to buy because they can buy it at a discount. And when they buy it at a discount, 3 or 4 years from now, they can hike those rental rates up to what the developer was projecting in the first place. So I think we're going to start seeing a lot more oversupply in the market. I think that's what's going to cause the market to stabilize, and then everything to kind of, I guess, go back to stabilization or where we were, and then deals start to happen more rapidly from there. All right, let's move over to our third and final article. So our third and final article reads, what does our third and final article read? Our third and final article reads, Freddie Mac tightens the belt. New guidelines aims to curb fraud. So today we focus on Freddie Mac's recent announcement regarding stricter guidelines designed to combat fraud in the multifamily loan space. So Freddie Mac cracks down on fraudulent activity. The Federal Home Loan Mortgage Corporation, Freddie Mac, a major provider of financing for multifamily properties, has announced the implementation of new anti-fraud guidelines. This move comes amidst increased scrutiny and reports of fraudulent practices within the multifamily loan sector. So here's what to expect from the new guidelines. The specifics of the new guidelines haven't been publicly disclosed yet. However, Freddie Mac's announcement indicates a focus on strengthening oversight and due diligence procedures during the loan application process. This could involve more stringent borrower verification, enhanced property valuation, scrutiny, and increased focus on transaction details. So what does this mean for you? While these new guidelines aim to protect lenders from fraudulent activity, they also might impact the loan application process for multifamily investors. Potentially longer processing times, greater transparency required, and that's just to name a few things. So that is what we have there. So this article about Freddie Mac strengthening bringing out new guidelines to kind of combat fraud. I think this is actually a good thing. So fraud is horrible in any business. You always want to make sure that you're getting qualified buyers, you're doing the right thing, and you're making sure that everything runs smoothly. And so when you kind of get lackadaisical, that's when problems start to happen. And so I actually think it's a good thing that Freddie Mac is kind of tightening the belt and getting more stricter, or looking at paperwork a little bit more critically to get deals across the table. Because I say this because it only makes everybody in the industry better. If you only look at deals and you look at okay deals and you can move a couple numbers around here and you get lazy and you're just pushing deals through the market, that eventually causes a problem. But when Freddie Mac starts to say, okay, we're going to get better and we're going to make sure we keep fraud down, everybody has to get better. The entire mortgage space has to get better. Here at the Party File, we have to get better when we're pushing our loans through. So I actually think this is a good thing. Freddie Mac tightened the belt. It's a good thing. They're in it early. They're catching the fraud, and you only can get better from here. So that is all we have today. If you want to see any of these articles, make sure you go to apartyfi.co/news and get on the newsletter. It's 100% free. It's delivered straight to your inbox every single day. And then you hop on the podcast and you listen to my commentary on what I have on this. And then if you need a multifamily loan, go to apartyfi.co/loans and we'll get you right. So that is all I have for today. Thank you for listening. Thank you for watching. Make sure you subscribe, leave a like, and let us know in the comments what you think about all three of these articles and share your perspective. That being said, I'll see you on the next episode.